Hey everyone, welcome in to another daily editorial here on the KE Report. We're getting an update from Mako Mining and a acquisition that was just announced March 26th of Goldsource Mines. Goldsource held the Eagle Mountain Gold Project in Guyana, South America. Okay, we are going to dive into this deal. We're going to talk about some of the more details on this deal, as well as what it means for Mako moving forward as potentially a multi-asset producer in different jurisdictions now. Mako Mining traded on the TSX Venture Exchange under the symbol MKO and on the OTCQX under the symbol MAKOF. We are chatting with the president and CEO, Akiba Leisman. Now, Akiba, look, Mako already producing in Nicaragua. Now you're adding on this Eagle Mountain Gold project for some operational diversification. We'll get into some of the details around what looks like this high margin gold project. But first and foremost, Akiba, give us a bit of a background on how this deal came together and what attracted you, Mako Mining, generally to this asset.
Sure, and thanks for having me on. Well, even going back to when we first started Mako, 2018, 2019, we had a three-stage strategy, which was to develop the highest grade open pit mine in the world. We did that, start production at 500 tons per day with the ability to expand it to 1,000. We kind of laid the groundwork for that, but we're still not there. And then to prove that this is going to be like an orogenic district, which I think we've actually made a lot of progress on that. The reason why that becomes important is that these tend to be district scale clusters that wind up having millions and millions of ounces of gold. When all is said and done, but even going back as early as 2019, I said that if we were able to achieve all three objectives, we would still be too small for our own good. It was a type of ore body over in Nicaragua that even in a best case situation, you wouldn't be able to extract much more than 75 or 80,000 ounces a year. Otherwise, it would have just been an impossibility to drill out that amount of resource to justify a plant build out beyond the aspirational 1,000 tons a day that we kind of built the civil works for back in 2019 and 2020. So external opportunities were always part of the equation. Now, Mako is a mining company. So and I've spoken about this on your show many times, is that when we talk about kind of what we do and how we present data and how we manage the business, the first, second, and third priority is making sure that we make rational decisions, kind of with the business in mind. It's like, are the decisions that we're going to be making good for the asset, the mine, the longevity, the continuity of the business operations themselves? And sometimes those decisions put you in a position where it's kind of like difficult to do things on the strategic side when it comes to M&A. And one of them, back in 2020, was that when we wanted to go and start to mine this, the first thing that we needed to do is make sure that we had a resource that we can get control on and develop a mine plan on that. So when we did that, we took the predecessor of Mako was a company called Golden Rain Resources. They had two resources that were put out in 2012 and 2015, showed 900,000 ounces of gold, but it was a lot of fluff that went with it. So in 2020, we established our first resource that was geologically controlled with our own data, and it became a much smaller resource on its own end. And that wasn't to say that the project was small and then like the potential of this wasn't what we were saying. It was quite as far from the truth as possible. The reality is that the exploration of San Albino has proven out every bit as much as what we expected on this. But in doing this and kind of like being honest with the data and how we established it, we kind of put ourselves in a position where there was a lot of heuristic boxes that were very difficult for investors to check. And then frankly, even other mining companies to check. So we get a lot of our criticism, some unfair. The fair criticism is like when we're dealing with M&A and we show our relatively small resource that's since been enlarged by investing in exploration and expanding to the Las Conchitas area that I've also spoken about on your show. When we approach other companies, they're like, all right, this is my feasibility study. This is your small resource. I don't really see how this is going to be a fit. And those conversations tend to fall away on the first few levels of discussion. What made Goldsource special, in addition to the asset, which actually fits a lot of the attributes that we're looking at in terms of low capital intensity, scalability, district scale potential of the camp that they're in, very, very similar to San Albino. But what makes it special for us in terms of doing like our first major acquisition is the people, right? So here you have the executive chairman of Goldsource, who's going to be stepping in as chairman of Mako, is Eric Fear, right? So he's the CEO of Silvercrest Metals, extremely successful mid-tier silver producer in Sonora, Mexico. And that was a spinoff from his last company, Silvercrest Mines, which had a very successful operation that was sold to First Majestic. But going back in history a little bit, when it was first developed, before Eric was even CEO of the original Silvercrest, and he hired the team to do the build out of the original heap leach, that was actually our operating team. So Jesse Munoz, before he was the COO of our company, was the president and head of his own family-owned engineering, procurement, and construction management firm called Sonoran Resources. And they did the procurement and construction management work for the original open pit over at Santa Elena. And Eric and Jesse get along famously. They're like brothers from another mother. They really have maintained a very close relationship over the course of the last, I guess, 15 years now. And likewise, I've known Eric. I think he's my favorite CEO of an intermediate silver producer, certainly in the Americas. I told him that too. I also have like a deep relationship with the CEO of the company, Steve Parsons, and he and I also go back many years. But the reason why these relationships are important, it's not because, oh, we all get along and have a beer together, let's merge so we can have more beers together. It's like, no, it's like the reason why the relationships are important is because we can actually have a conversation with the other side and say, look, guys, this is something that you want to spend time to figure out what we're doing. What we actually have in terms of our public data, in terms of what's been delineated from a resource perspective, which inhibits us from having conversations like I described earlier with other mining companies. If you spend the time to actually look at the geology, and if you spend time to look at our operations and what we're doing, and you spend time to look at how we built this project, which is almost an equivalent flow sheet to what you have over in Guyana, and we built this during the pandemic between 2019 and 2021, you'll realize that there's a lot of synergies between these two companies. So the first like serious discussions with Goldsource really go back to maybe the second quarter of 2022. So this is now approaching almost 2 years. But they spent a lot of time going over what we're doing. They spent the time and effort to kind of understand what we're doing. They kind of knew who we were. They knew it was worthwhile to at least investigate it. And over the course of now years of these discussions, they kind of recognize what we can bring to the table to really transform the asset that they have. So the team comes together, the assets come together, where you have a cash flow producing mine over at San Albino that not only is going to be able to capable of funding big boy exploration programs over in Nicaragua, big boy exploration programs over at San Albino, but it's going to go a long way at contributing the equity that's needed to go and build Eagle Mountain when all is said and done, when the construction decision is made. But more importantly, this deal kind of like fixes both of our deficiencies. For us, it was jurisdictional risk and small resource. For them, it was, while they have like great technical capacity individually, they don't actually have like a lot of technical breadth within the company just because they're small. So here, by inserting like our operating team over here, you're able to instantaneously de-risk the engineering and the build out of Eagle Mountain. You're able to have cash flow that's coming from an operating mine. You're able to have a financial backer that will be there in case anything goes wrong. And I use the term kind of hand in glove, is that the outcome over here, the company winds up looking a lot better. This really is 1 + 1 = 3. And the way that I describe it, it's not just a merger, it's not just a partnership, but it really sets us up as a platform where a lot of these discussions with other companies are going to be a lot easier, where you don't actually have to rely on multi-decade relationships in order to get somebody to allocate some time to basically figure out that what we've been doing over the course of the last 4 years was anything but crazy.
Well, Akiba, let's go a little bit further down that rabbit hole as far as the hand in glove fit. You mentioned the synergy between the teams, but I'd love you to dig in a little bit more to the jurisdiction diversification. You mentioned in the press release that it's a geographic diversification, but it's also, like you're saying, a diversification of skill sets on the two teams. And your team has that engineering and mine building background you can bring to the table. How does that help the 1+1=3 scenario play out?
Right. So there's a lot of similarities between Eagle Mountain and San Albino. Not great. Obviously, San Albino is off the charts great, but there's also a lot of off the charts complexity that comes with our mine in Nicaragua. But what Eagle Mountain is, in a very similar fashion, it's a few things. One, these are shallow deposits. Eagle Mountain is effectively tabular, so it's almost like a horizontal ore body, very similar to our shallow dip over at San Albino. Well, if you go through their PEA and their geology, there's talk about it being an orogenic system. It's like that's a little bit less important. I think there's kind of like debate about what the system is. Certainly some unique attributes that are also analogous to San Albino in that regard. But the other thing that's very analogous to San Albino with Eagle Mountain is that it really is scalable. So effectively, there's two types of ore that's going to be within their ore body, their resource. There's the easy to process saprolite, and then the harder to process hard rock. And really, it's just a question about additional energy requirements, getting the grind size down, certainly a lot more. So they're basically like two bits of the project, kind of very similar to San Albino, where effectively you started with one open pit, you grew to multiple open pits, and eventually you're going to be underground, and then you grow from there. So it's inherently scalable just because of the nature of the geology. And just like we did with San Albino, is that we laid all the civil works to make this 1,000-ton-a-day operation, but we only built like one half of that train, knowing that if we ever wanted to make the decision to expand, it would always be there. We can always come back to it. And that's kind of like the way that we deal with it. Not every mining project is scalable, right? So there are certain projects that need to be built big from the start, right? So mining is a capital intensive business, and you often need kind of scale in order to make these things work. San Albino happened to have been particularly well suited for scalability. Eagle Mountain is particularly well suited for scalability, and that's why these kind of assets fit together. Jurisdictionally, I mean, Guyana and Nicaragua are not all that far apart from one another. You look at a map, you said, all right, it kind of makes sense. So in terms of our ability to manage those time zones and being able to get it, I love the fact that there's I live in New York City, and there's a direct flight to Georgetown. I think that's amazing, right? For a mining project over there. From a logistics perspective, it's pretty seamless. And then you have the very special nature of what Guyana is these days, is that they made a $1 trillion discovery offshore that's changing every aspect of Guyanese society. And the knock on Guyana 10 years ago was that, all right, there's a lot of geological potential. There's a lot of similarities between Guyana and West Africa. So there's a lot of similarities between Guyana and Ghana, if you will, definitely spelled in different ways. But the problem is that nobody has been able to find these monster deposits in this country because they happen to be undercover. It's very lush. It's a jungle environment. And they really didn't have a lot of infrastructure to make it a low-cost way of developing a lot of these assets. All of that's changing. The oil that they found offshore is changing every aspect of society. There's capital to make major infrastructure improvements. And then over time, it's just going to get better and better to be in a mining jurisdiction. So you have all the potential in the world where a lot of the key risking items are in the process of being de-risked just because of this wonderful natural resource find that they made offshore. And then in terms of just like diversification in general, it's that I do think that there's kind of like a sweet spot for how mining companies should be arranged. Being a single asset producer in a single asset jurisdiction or a single country jurisdiction inherently means you have idiosyncratic risk that goes with the operations of your business. And it's not just geopolitical. Like obviously Nicaragua has gotten some of their geopolitical challenges, but it could be something that is parochial like we went through in 2020. I mean, think about during the build out of our mine, we got hit by 2 hurricanes in a hurricane season where they ran out of names, right? So we got hit by Hurricane Eta and Hurricane Iota. There was like I think in in 100 years prior, Nicaragua was hit by 7 major hurricanes, and we got hit by 2 Category 3 pluses within 2 weeks of each other after they ran out of names for that season. Just by being in more than one jurisdiction, the idiosyncratic risk of a random weather event, or maybe not random weather event, goes down. So at some point, though, the ability to manage like a large portfolio of assets, there's a law of diminishing returns. So I don't think we're going to be like a mining company that's going to have 10 mines under our belt. But having certainly more than one is better, and probably multiple, even beyond this, is probably ideal. But the one good thing about both Nicaragua and Guyana is that here you have governments that are very supportive to the mining industry. We're able to do things. We're able to do things quickly in an entrepreneurial fashion where we can focus on making rational decisions at the mine site. So we've had tremendous success operating in Nicaragua, and we hope to have tremendous success operating in Guyana as well.
All right, Akiba, let's just get a little bit more information on this asset then, because it was just this year, a couple months ago, January 2024, there was a PEA released on this Eagle Mountain Gold project. The economics around it, quite impressive. When you look at the after-tax IRR of 57%, talk to us a little bit more about the actual economics as they are released to the market, including capital costs for when you move forward with development.
Yeah, I mean, it's something as simple as they have a project over here with a relatively low capital intensity. So in terms of the amount of capital that they need to go and develop the project relative to the NPV that their preliminary economic assessment indicated at lower gold prices, it's a relatively low capital intensity, but it's still like a capital number that was going to be multiples of their market cap. So you kind of like put into a couple of categories in the junior mining space. You're either there with a world-class asset that exploration investors are going to invest in. You have like a large scale, potentially mine that a larger company might buy you out for. And then there's a lot of these subscale assets that don't really capture the attention of a lot of the mining community. Some of them just don't work because they're not good assets. Some of them are fine, but they're just not of scale that would be of interest to a larger mining company. And then you're kind of stuck trying to finance this on your own. And so then you're kind of like on a treadmill over here in terms of, well, how are you going to get this? Where's the capital going to come from? And I've been talking about this a lot today after the deal was announced. This whole notion of price to NAV in terms of a valuation metric when it comes to pre-production junior mining companies is that basically is a phantom of a valuation approach, because one of the things that you need to model and understand and contextualize is that where's the finance and at what price are you going to go and build the mine if you're going to need to do this yourself? Eventually, you're going to need to be valued on cash flow. And if you don't have like a good way of going and financing your project build out into cash flow, you can wind up, establishing that price to NAV as kind of like the right price, because if you actually walked your way through all of the dilution that it's going to be needed to develop this project, you know what, the price that you're going to get means that you're actually not trading all that cheap. So this is not a Goldsource specific issue. I think this is kind of like the general position that not everybody. I think that some people have like truly special projects from an exploration perspective. They're above scale, which is like the M&A candidate. But like the 90 to 95% of the industry is kind of in the subscale ones. And again, most of those are assets that probably wouldn't be attractive. But the ones that actually are attractive, like Eagle Mountain, they kind of get plumped into this thing where you kind of get stuck. So instantaneously, we unstick that, right? So we unstick that by instantaneously. We're basically saying that we have a clear path to development. I actually had a meeting with some of the higher levels of the Guinea's government with the Goldsource folks over the course of the last month. And I said, look, the first thing that I did when I took over Mako was go to a government official in Nicaragua and say, we're going to build this thing. And that was 2019. And we financed it. There was a global pandemic. We still built it. Very, very few delays in terms of what would happen after that pandemic. And it was something that we established a credibility with the government of Nicaragua on that. Same thing with Guyana. I said, look, we're looking at this merger and acquisition. We want to have the continuity of the team. It's a key piece of this deal over here. But when we say we're going to build it, we're going to build it. Now there's a lot of work that actually needs to go into it before we actually make that construction decision. But you can say that if I'm going to say that we're going to be building it, we're going to be building it. And that really goes over a long way, especially when you have a track record that you're able to do this. But going back to valuation, the second that you turn these things into these kind of like lost projects, into things that are truly future mines, the entire framework of valuation changes. It unsticks you. You're no longer in these depressed priced, these phantom price to NAV type ways of discussing valuation. And instantaneously, you're really looking at this thing as a discounted cash flow that's going to be coming really not all that many years out. All right. If everything kind of works seamlessly, we have the expectation that we can be putting this thing into production by the end of 2026.
Well, Akiba, we'll wrap it up there, but it is an exciting transformational transaction for both companies, and it hopefully is a 1 + 1 = 3 scenario because both teams, both skill sets coming together, both complicated assets, but your team has the experience working with complicated assets very successfully, and it's just a pretty important day for both companies. If people want to follow along with the news, there's also going to be a link under this interview. It takes you over to the Mako news section at their website. And Akiba, always exciting to talk with you about the developments at Mako Mining. This one particularly interesting, and we'll keep following on, looking forward to our next conversation.
All right, great. All right, thanks, Ed. Thanks, Corey.